Hey everyone, welcome back to Corporate Decoder. Today we're diving into a 10Q filing so dry it'll suck the moisture out of your eyeballs, but don't worry, we'll extract the interesting bits. Richmond Mutual Bancorporation just dropped their quarterly report and the headline is a slight profit dip, but is it really something to worry about? We'll check into their loans, investments, and whether this small bank is playing it smart or just lucky. Stick around. Before we get into the numbers, if this is your kind of thing, make sure you're subscribed and check out the Discord, link is in the description, where you can find more great people talking finance. Alright, let's dive into the good stuff, the balance sheet. First thing to notice, total assets went up a little, $17.9 million to $1.5 billion. That's a 1.2% increase. Sounds good, but let's find out what's driving it. Looks like the engine here are loans, which increased $17 million to $1.2 billion. Basically, they are lending more money to people. At the same time, investments and securities went down by roughly the same amount, $2 million. That's not necessarily a bad thing. It seems like they're moving away from just holding securities and instead focusing on their primary activity, giving out loans, which could mean they see more profit in that. On the other side, the money people put in the bank deposits also went up $11.7 million. More deposits means more money available to give out as loans. Their stock value, called stockholders' equity, decreased by about $2 million. This is not ideal, but we should check out why before we panic. This can happen when a company buys back its own shares, which can be good for the price but lowers their cash on hand, which is indeed what they did. They are hoping that stock price goes up after they trimmed it, so it is definitely a bet by them. That we should check out why before we panic. This can happen when a company buys back its own shares, which can be good for the price, but lowers their cash on hand, which is indeed what they did on themselves. Next up, let's look at the income statement. This will tell us how well they made money during the 3 months ended March 31. Right off the bat, net income is down about $400,000 to roughly $2 million. This is not great, but it is just a quarter, so let's see what happened. Total interest income, the money they made from loans and investments, increased by $1.4 million. It seems like they made more money off their assets, so this decrease in income must be coming from somewhere else. Their total interest expense, what they pay to depositors and for borrowings, went up a lot, almost $1 million. This probably has to do with the current economy and more people wanting to get paid for the money they deposit. Also, their provision for credit losses, the amount of money they expect to lose from bad debt, went up almost $600K, so they expect more people to fail paying their debts. Yikes. They are also spending almost $400K more in non-interest expenses, so basically everything is costing them more. The earnings per share, which measures how much profit goes to each share of stock, also went down a little. Let's quickly check comprehensive income for any other insights. Not much here, but one thing. They made over $1 million in unrealized gain, meaning their investments mostly grew, even though they did not sell them. Now let's peek at the cash flow statement. Cash flow is king, as they say. It looks relatively the same as last year, so no biggie. Net cash used in investing, i.e. buying things like other companies, is smaller than last year, but still negative. This might be a result of lower profits. They are using financing activities, loans, and other activities to earn money, had debt to drive their operations. Net cash went up quite a bit, over $5 million. That's a good sign. All right, let's now jump to the notes section of the filing and find any caveats. The company has one reportable segment, community banking. That means they mostly do just one thing. Here we see that adoption of ASU number 2023-07 did not have a material impact. That seems very boilerplate, so we can ignore it. This just shows a bunch of numbers regarding their investments. Nothing too crazy here, except that they have unrealized losses, which is bad. Diving deeper into their lending, we see different risk ratings on loans. So what are their loan quality ratings? Turns out they rank their loans from exceptional all the way down to loss. I wonder what a loss loan looks like at this bank. Definitely not a good grade. Alright, almost done. Nothing to report on legal proceedings, very standard. And finally, no material changes in their risk factors, also very standard. So let's wrap it up. Tibino, Dofferall, Richmond Mutual Bancorporation seems to be doing okay, but not amazing. They're making more money on their loans, but it's costing them more to tend. What I like in moving away from securities to loan production, and their equity is okay. What I dislike, their earnings are dropping if the increase in the money they expect to lose on debt. A provision for credit losses, that means there is potentially big issues that could come in the future. The big risk is those rising interest rates and a potential recession. If people start defaulting on loans, that could really hurt them. But overall, they are a relatively small, simple bank, so they are not really moving the world. So in the future, I'd keep an eye on those loans and how well people are paying them back. Alright, that's our deep dive into Richmond Mutual Bancorporation's latest filing. What do you think about this community bank? Drop your thoughts in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more financial deep dives. Also, join our Discord, link is in the description, where you can talk to people passionate about finance. Thanks for watching. I'll catch you in the next one.